Imagine two people. Same job. Same salary. Same city. 10 years later, one of them has $180,000 sitting in an investment account. The other has $12,000 in a savings account and wonders where all the money went. What was the difference? It wasn't luck. It wasn't a secret tip. It wasn't even that much money to start with. The difference was one decision. And most people never make it. Not because they can't, but because nobody ever explained it in a way that actually made sense. So today, let's fix that. Here's what most people think investing is. Something complicated. Something for rich people, Wall Street guys in suits, or finance bros who memorize stock tickers for fun. So they do the safe thing. They keep their money in a savings account. It feels responsible. It feels smart. But here's the quiet problem nobody talks about. Inflation, the slow, invisible rise in prices, is eating your money every single year. If your savings account pays you 1% interest, but inflation is running at 3%, you're actually losing purchasing power. Your money is shrinking while it sits still. Doing nothing isn't safe. It just feels safe. That's the trap. So what is the stock market, really? Think of it this way. When you buy a stock, you're buying a tiny piece of a real business. When you buy one share of a company, you literally become a part owner of that business. If the business grows and makes more money, your piece becomes worth more. Simple as that. Now here's where it gets interesting. You don't need to pick individual companies. In fact, most people shouldn't. Instead, you can buy something called an index fund. Think of it like a basket that holds hundreds of companies at once. You buy the basket. You own a little piece of all of them. The S&P 500 index, for example, tracks the 500 biggest companies in America. Historically, it has returned an average of around 10% per year over the long run. Let's make that real. If you invest $300 a month starting at age 25 and earn that historical average, by age 55 you could have over $600,000. Not because you were a genius. Just because you showed up consistently and let time do the heavy lifting. That's the power of compounding. Your returns start earning their own returns. It snowballs. Here's the psychological part that most people miss. The stock market goes up and down constantly. Some months it drops 10%, 20%, sometimes more. And when that happens, every instinct in your brain screams, "Sell everything, get out, this is a disaster." That instinct is called loss aversion. Psychologists have found that losing money feels twice as painful as gaining the same amount feels good. So when the market dips, we panic. We sell. We lock in the loss. And then we watch the market recover without us. The investors who build real wealth aren't smarter. They're just more patient. They understand that a temporary drop is not a permanent loss, unless you sell. The market has recovered from every single crash in history. Every single one. So here's what you actually do. Open a brokerage account. Platforms like Fidelity, Schwab, or Vanguard make this simple. Choose a low-cost index fund. Set up an automatic monthly contribution, even if it's just $50 or $100. Then, Most importantly, don't touch it. You don't need to watch charts. You don't need to predict the economy. You just need consistency and patience. The stock market isn't a casino for the lucky. It's a wealth-building machine for the consistent. The person with $180,000 didn't find a shortcut. They just started, stayed calm when things got uncomfortable, and let time work in their favor. The best day to start was yesterday. The second best day is today.